All right, so welcome everyone. Before we get started with Jared, I just have a couple quick announcements. Not sure, I had sent an email out that the 4012s and the 6744s have arrived. So for those of you that were not at the training this morning, you're able to go over to the United Way of Lancaster County's main office, which is on 1910 Harrington Drive, to pick up your booklets. I also put out some 3-ring notebooks. So if anyone needs a notebook, grab one. I will keep putting them out as they are taken. So feel free to take as many as you need. Some folks have also asked me when Lincoln Learn will be up and ready for you all to take your test. There are some individuals that are ready to go. I found out I was on another webinar yesterday with the IRS, and Lincoln Learn should be up and ready to go November 15th. Just know that there will be updates going on for probably a week or so until they get everything up that's needed. But if you're ready to take your test, that should be ready for you to do. Other than that, that is all I have for tonight. So I'm going to turn it over to Jared.
All right. Well, thank you very much, Kim. Appreciate everyone coming back. Glad to see we didn't lose too many people from the first week to the second week. Hopefully this week is even more engaging than where we're at from the initial time. But we're going to be covering topics including income today. So a little bit of a change from where we were last week when we talked a little bit more about areas of dependency and filing status. So it's going to be a little bit more hopefully clear cut in how we're going to go through a couple different processes here. So I'm going to try and make sure that we're getting the sharing mechanism down here. And again, using a couple different monitors. So I want to be sure we're giving you the right view of at best possible here. So hopefully you are able to see our presentation, starting off with our VITA Volunteer training number 2. What we want to cover today, as I mentioned, is really focusing on taxable income. So what you'll see on your screen is taking a look and some basic taxable examples we're going to have throughout the VITA season. Again, the reference is in the upper right-hand corner to our 4012. So as Kim mentioned, that's the document that is now available for your reference. In addition, not only do you have a hard copy available at the United Way, but also you can also download that publication from the IRS website if you like, and have it right on your desktop. So kind of a great way to have some reference. I don't want to make this look like it's incredibly daunting, but that's all the income that we would possibly have that would be taxable within the VITA program. And I'll go through a few main highlights of these as we go through the presentation this evening. But also wanted to mention, not just in addition to our taxable items, we also have a number of non-taxable items. So this usually comes into play when you have a client coming into VITA and asking, how do I handle the following pieces of information? So what we're going to have in front of you here are some non-taxable examples from D4 of your 4012. Those include things like child support, damage for physical injury, any type of sickness or injury payments, any type of federal refund that anyone's had in a prior year. Big one that we run into a lot is gifts and inheritance. Sometimes people ask, I'm not quite sure what's going to happen with my tax return. I just inherited some money from a late uncle. What does that do? Well, fortunately for the recipient, there is no tax at all from a federal standpoint on gifts. Same thing with inheritance. Generally, if you're going to get an insurance payment, it's to compensate you for a loss. Generally, those are not taxable as well. We're going to have some tax-free income, generally happening with our state and local municipal bonds, that type of thing. Again, veterans benefits, welfare benefits, and workers' compensation, not taxable as well. So the general rule of thumb is if you are being compensated for a loss or injury, particularly health-related, it is generally non-taxable income. If you're being paid to work on account of not being able to work because you're in between jobs or in case of retirement, those are generally going to be taxable items. So I want to spend a little bit more time this evening walking through a couple of these items of taxability, and then also mentioning which ones are going to be the most common ones that we're going to find within VITA. And those are the ones that I've listed next on your slide sheet here, which is the basic ones on the Form 1040. So we're going to talk about W-2 wage income, which is found on line 1A. We're also going to talk about interest income, and you'll see some commonalities of where these pieces of information will be reported. So wage income will be coming off of Form W-2. The interest income will be coming off of Form 1099 INT. That'll be reported on line 2B. Not that you really need to know where they end up on the return immediately. We're going to show you over time how we actually enter this information into the TaxSlayer program. So what we want to identify is just what are the common types of income we have. In addition, in the same input screen, we have our interest income. We also have dividend income, which is going to come off the 1099 DIV. That'll be just shown on the 1040 on the line immediately below our interest income. We'll also have IRA distributions, 1099R. That'll be on line 4B, and then also pension and annuity distributions. Those are also on a Form 1099R. They're just going to be reported on the line beneath there, and we're going to show you what makes the difference between the reporting. All of these will be considered taxable income, so we'll just show you how to enter that information within TaxSlayer. The other most popular one we're probably going to have is Social Security benefits. So not to daunt you with that big list we had that had quite a bit, a little over 20 indicated items of income, but predominantly we're going to be falling within this range here for most of our VITA clients. There'll be a couple examples that I want to go through that might be a little bit longer in that activity, but predominantly these 6 will be the majority of the income that we'll probably see for the season. We also want to talk about alimony income. So alimony received. This is an area that generally, if someone's been receiving alimony for a period of time, any alimony they continue to receive will still be taxable. There was a tax law change. Any divorces that occurred on or before December 31, 2018, the alimony was going to be taxable income. So the recipient, the person who's receiving the alimony, is going to have to pick up that alimony as taxable income, and the payor is going to get that as an alimony deduction. Again, we'll cover deductions next week. But those are only for divorces before the end of December 31, 2018. For divorces that occurred after that period of time, starting January 1, 2019, the alimony is not taxable income. So if you have a client coming in and say, I really don't know what's going to happen with my tax return, I just got divorced, here's the amount of alimony that I received for the year. Well, if divorce occurred in 2022 or 2023, good news, that's not going to be taxable income for the recipient. So we do need the date of divorce on line 2B when we get to the alimony area. So we need to know the amount of alimony and the amount of, or the date that the divorce had occurred. We're going to talk about unemployment compensation. So I know that is a question as to whether or not unemployment is taxable. It absolutely is taxable for federal purposes. It is not taxable for state or local here in Pennsylvania. For federal purposes, it is going to be taxable in full. For those of you who might have been volunteering for a while or been preparing returns, a couple of years ago, we had a mid-season change where they decided that a portion of unemployment would not be taxable. We are not foreseeing that activity happening this year. So we're going to show you how to enter unemployment compensation into TaxSlayer that will be populating on what we call the Part 1 of Schedule 1 and then flow over to the 1040. There'll also be some other income I'll finish off the evening with and just tell you about a couple different miscellaneous pieces that we may have and how that can be reported. So again, if you have any questions, feel free to pop those into chat. I will be trying to keep an eye on those as we go through. And Kim, if you see anything relevant, just feel free to throw something at me or ding me or something else to grab my attention here. So we will hopefully keep an eye on your questions as they come in. What I wanted to talk about is some of these more common forms of income and just give you a couple examples. The first one we're going to show you here is a W-2. Now, the W-2 may come in a variety of different forms and sizes. So each one may look a little bit different. Once you've been preparing returns for a little while, you'll start to get a feel of how these are going to look. All of the W-2s contain the exact same types of information. The layout might just be slightly different. In our case here, this is a relatively large W-2. You'll see at the very bottom, there are a couple different copies. So if a client comes in and they bring all 4 copies of the W-2, that does not mean they're unique W-2s. It doesn't mean we have to enter all 4 into the system. So we just want to double check. Often there'll be a copy 1, copy B, all kinds of copies. We only need to enter 1 copy with all the complete information into the TaxSlayer system. And what we want to be able to do, because we're filing returns electronically, is we want the W-2 to match the actual copy the client brings in. So the input should be exactly what we have in front of us here. So you'll see a couple different points here on the W-2. The main one is that making sure we have the employer identification number, EIN, entered in correctly. So that's going to help the IRS match up the W-2 that's given to the taxpayer with what we're entering into the system. And again, we'll just enter the employer, basically their name, their address, all the other relevant information. So the good news is typically within TaxSlayer, the first person at your site to enter the information will have to do all of the typing for that year. They'll have to put the EIN, they'll have to go ahead and enter the address and the employer name. And then the second time someone enters the EIN, it should pre-populate. So we should be in pretty good shape. Again, if you, not to probably have Kim get all upset and everyone wants to volunteer for the second week, so they don't have to do a whole lot of typing. But eventually these W-2s will be a little bit easier to put in each time. One thing we do want to point out is that taking a look at the Social Security number on the W-2 is going to help us do two things. One is identify to make sure it's a taxpayer or spouse. So you do have that option in the entering system. So we do want to make sure we have the correct taxpayer or spouse that we're going to populate the W-2. Another issue that we mentioned at the very end of last session was identifying potential resident aliens who may not have a valid Social Security number. Even if they're using ITIN, if they get a W-2 with a Social Security number, we want to go ahead and make sure that Social Security number is entered into the system. And then I just want to point out a couple different pieces here with the W-2 itself. So taking a look at the W-2, you'll notice that there are some box information in the upper right hand of our demonstration here. Again, these could be slightly different for various W-2s, but these actually work out very nicely because the font is very big and easy to read. The main information we're going to have is our taxable wages coming out of box 1 of the W-2. So that is the primary driver for what's going to end up as a taxable income item for the federal return. As you see the W-2, we just want to enter the information as we see it. So as you see the W-2, just go ahead and key that information into TaxSlayer. Box 2 will have our federal income tax withholding. Very important component because that's going to be helping to offset any tax liability and could potentially help generate a refund for the taxpayer. Now, here in Pennsylvania, we may have a slight difference between our Social Security and federal taxable wages because Pennsylvania allows for the deductibility. Well, I should say the federal government allows for the deductibility of contributions to retirement plans. So I just want to mention that the system may try to pre-populate the information thinking that they should be pretty well right in line with box 1, but go ahead and make sure you enter those correct numbers in there. So Social Security and Medicare generally within our VITA clients should pretty much be the same, but you do want to double check to make sure that all the information is entered exactly. TaxSlayer will try to go ahead and pre-populate the Social Security and Medicare. Again, just make sure that those numbers are pretty close. We can go ahead and leave them as is if they're within a penny or two. Now, I do want to mention there are a couple different boxes here that are not filled out in our sample W-2, but could be important as you're going through the preparation process. One of those is box 10. So box 10 is what we call dependent care benefits. That is actually representing an amount that the taxpayer has had withheld from their pay in order to help cover their dependent care costs. So that could include child care, it could include health care for a spouse, but we want to put that information in because that's going to be important as we talk next week about the Form 2441 or the Child and Dependent Care Credit. So that can either be used to help determine the amount of the credit, or in some cases, they may have had, the taxpayer may have had more benefits withheld than what they were entitled to. So there might be a item coming back into income. Again, TaxSlayer will take care of that. We don't need to do any manual calculations. And I probably should have started off by saying we don't need to do any math as well when it comes to tax return process. Immediately beneath that are going to be areas that do impact the calculation of returns. These are going to be our box 12 items. So these are going to be areas that might have some applicability. Generally, the codes are going to be available not only in your 4012, but also if you have a question about what the code is, you can turn the W-2 over. One of the copies should have a list of the codes. Common ones we're probably going to see here within Pennsylvania are going to be a code C, which is for group term life insurance. The applicability is going to be more on the state side than it is a federal, but you're also going to see codes D, code E. Those are going to be pre-tax contributions to a retirement account. You may see a DD designation. That's going to be an employee contribution to medical plans. So health insurance, any co-pays along those lines that they have in terms of their insurance. So we do want to put the information from box 12 into the TaxSlayer system. A couple of those pieces of information will help go to various components. And we also have another little box here in the middle called retirement plan. So you do want to see if there is that box is checked on the W-2. You want to check that box as well. That way the system will do the appropriate calculations as we go through, again, take a look at some credits and possible deductions. Here in Pennsylvania, we do have not only a state tax, but also a local tax as well. So we do want to fill out the information provided by the W-2. So what we'll do is we'll enter the state information in on the screen for TaxSlayer. It will, again, attempt to go ahead and treat the taxable wages basically the same as what federal income is. Now, here in PA, we have generally a slightly different process. So our state wages are generally more aligned with our Medicare wages. That's kind of what the state's typically looking for. The reason why is Pennsylvania does not give you a deduction for any of your pre-tax contributions to retirement plans. So while you have that ability to deduct that for federal purposes, again, it's going to be accounted for in the W-2, PA wages are going to be higher. PA also has an adjustment allowable for the group term life insurance, as I mentioned, code C in box 12. That is done automatically. So what we want to do is basically enter the information exactly as we see it and the W-2 provided to us. So that's going to include our state wages, including our state withholding. In box 18, we'll have the area for local withholding. The local wages, and in box 20 will be local withholding. And then the very last one I want to talk about is that one that says locality name. So that box is going to be helping to indicate where the locality is in order to prepare better a local return out of the TaxSlayer system. So probably depends on your site coordinator. Typically, if I'm preparing returns and I know they're going to be in Lancaster County and they're going to be in one location, I will put just code 36 in to the locality name on the input screen. That makes it a little bit easier for the local return. We'll talk about that preparation in our fourth session. But pretty much we will enter the information exactly as reported on the W-2. If there are any issues the client has and they don't believe that the W-2 is correct, unfortunately, we cannot correct those. Best bet is to have them go back and talk to their HR department and determine if there is an issue on presentation with the W-2. There may be, yes, I'm sorry, Kim.
I did have a quick question.
Yeah.
What if the employee's address on the W-2 is different than the 1040 address?
Yeah, perfect. So great question. So what we want to be able to do when we enter the 1040 address, it should be the current address of the taxpayer. So we want to be sure that the address that we have on the front page of the 1040 is where that person is currently living. If the address on the W-2 is different, go ahead and update that address. There may be some things we need to take a look at in terms of moving between municipalities. If they're all within the same local taxing jurisdiction, we're in pretty good shape. And I'll talk in session 4 a little bit about what we do with moving in and out of states, which gets to be a little bit more of a interesting topic. But yes, the W-2 should be entered in predominantly as it's presented by the taxpayer. So we want that to match as best possible to what the government's going to have. All right, great question, though. Any other questions on the W-2 before we move on? Okay, just want to make one other quick comment here on the W-2. The amount that we have sitting on the local and state line should pretty much be one line. There may be a second line that comes in if the taxpayer may have moved localities throughout the year. That'll come into play if we prepare a local income tax return. If you see a second line on a W-2 and has indicated in there wages and then withholding at $52, most likely it's because that the employer put their local services tax in the incorrect line. The local services tax, as you see in your example W-2, should be in box 14, indicate a couple other different pieces of information. We do not input box 14 information. That does not automatically carry anywhere on the return. So for our VITA program, we are not entering information in box 14. If there's pieces here that we need to address, we will certainly take a look at those, but they will not automatically calculate for our purposes. So we just want to take a look at the W-2 again, kind of mention, enter those exactly as we see them. All right, moving along to our first, the 1099 series. So very important, if the client gives you a document that has a 1, a 0, and 2 9s in it, we're going to want to have that information show up on the return in some fashion. Those are documents the IRS is also going to get a copy of. So What we want to be able to do is the first way to ensure to avoid tax notices is to make sure we're matching the information on the return that's being filed to what the IRS has on record. So we want to be sure that all the information we see from a 1099 is going to make its way onto the tax return. In our example here, we are showing you a 1099 INT, and the INT, fortunately for our purposes, really easy, stands for interest income. If you have any questions as you get these documents coming in the upper left-hand corner of TaxSlayer, you can actually type in the search bar 1099 INT, and it'll give the opportunity to click a link that goes directly into the input section of where you can put that information into TaxSlayer. So in our example here, we have some basic information. We have interest income showing in box 1. That would be predominantly the main source of income we're going to have for a taxpayer when it relates to interest. For many, many years, I said, hey, don't worry about the 1099 INT. First of all, 2 reasons. 1, a 1099 INT is not required to be issued by the person paying interest unless it's over $10. And it's only going to be coming from an institution required to report 1099 INT. So it's not going to come if you are having a loan between a parent and child. That's not going to show up. You can still report that interest on your return, but it's not going to generate a 1099 INT. Another scenario that often comes in is I may have a client say, I'm not quite sure when my bank didn't give me the 1099 INT. I know I had interest. I had 36 cents last year. I can show you the ending bank statement. I don't know why they didn't give me the 1099 INT. Again, only issued if it's $10 or more. We can certainly go ahead and report that $1 of interest, and that's even being generous in the rounding. But you can go ahead and put $1 of interest income on the return if you like. Probably should not have a significant impact on the taxpayer's return. Another reason why we haven't seen these as much is the interest rates, quite frankly, haven't been that high until the past 2 years. And now we're actually starting to see interest rates climbing on savings and money market accounts. So we may see a few more interest statements come through. So just want to show you predominantly what we're going to be looking at is box 1 of our 1099 INT. There could be an early withdrawal penalty if someone takes money out of a timed account, mainly a certificate of deposit a little bit early. If there is anything on the 1099 INT, enter it exactly as it's shown. It'll automatically flow within TaxSlayer to the correct boxes on the 1040. Another area that we have is interest on U.S. Treasury bonds and Treasury obligations to savings bonds. That is going to be taxable for federal purposes, but exempt for state purposes. So again, if you see anything in line 3, go ahead and enter that. That's predominantly coming from probably people cashing in a savings bond. And we'll take a look at how that'll work when we get into the computer program and show you how to get that to work for PA purposes. All right, so very similar to the 1099 INT is the 1099 DIV, and the DIV is going to stand for dividend. And what we're going to show you here on the dividend schedule, again, as you see these pieces of information, enter them exactly as shown. The input screen for 1099 INT and DIV are at the exact same point. You just need to indicate, first of all, is it for interest or is it for dividend? And then we want to take a look and see, is the recipient the taxpayer, the spouse, or is it a joint account? So quite often we may see investment accounts that are actually in joint names, so a joint savings account or potentially a joint brokerage account, so you can pick the appropriate category. Again, what you want to do is enter the information exactly as shown on the document. So in our case here, we're going to show that we have $1,256 of ordinary dividends. That's the total amount of dividends paid. To the fund, it could be reinvested, it could be paid in cash, but that's how much of the dividend has actually been paid. Immediately underneath that, you'll see 1B. That's qualified dividends. That is determined by the effectively the broker or the company has the taxpayer met the required needs for the dividend to be treated as a qualified dividend. There's a holding period requirement, so they don't want people buying and selling frequently. But if you hold on to the stock long enough, you'll qualify for what we call qualified dividend. The benefit here is a qualified dividend actually has very low tax rates. You're not going to work at the same tax rates as ordinary income. They could be taxed as low as 0%. And in fact, most of our VITA clients, if they have qualified dividends or long-term capital gains, will be taxed at that 0%. So if you see that we have some income on the tax return, it shows taxable income and shows tax as 0. It does not mean that we have a problem with our tax software yet. It may mean that they have sufficient amount of either qualified dividends and or long-term capital gains, which means that they're not actually going to pay tax on those dollars. So right underneath that is a line 2A, which is total taxable distribution. So that's a capital gain distribution coming out of a mutual fund or some other type of investment account. There may be a couple other things on the 1099 DIV. Generally, we do not have a lot of complex investment activity with our clients here at VITA. But again, as you see the information, go ahead and just enter that in to the 1099 DIV. All right, changing gears just a little bit. Want to go ahead and mention about our unemployment compensation. So the unemployment compensation would be presented in a 1099-G, and the G is going to stand for government payments. So this is our typical form we'll see to enter our unemployment compensation. So typically the taxpayer will bring that in. They'll say, I've been unemployed for a period of time, and here's a form I had gotten from the state. What you'll see here is we're just giving you a sample. For those of you who have done unemployment compensation before, you know that the address actually in PA is not 1 Commerce Street, but it's actually 651 Boaz Street in Harrisburg. I have typed it so many times, it's muscle memory. I don't even need to look at the keyboard anymore to get that in. So again, once the first person at your site has put in the payer identification number, the federal identification number, it should pre-populate once you get that number in. A couple things to keep in mind with unemployment compensation. The total amount of unemployment compensation will be shown in box 1. Hopefully, the client has elected to have federal income tax withheld. That would be shown in box 4. The reason why we are hoping that they have the box 4 filled out is that it is taxable for federal purposes. So generally, they will have a position where they'll withhold 10%. Our lowest tax rate within VITA is a 10% rate. So hopefully that is withheld to at least stave off any additional payments or reduction of credit down the road. So again, as we mentioned, unemployment compensation is taxable. You're actually getting paid not to work. So any type of compensation you have for working, retirement, or not to work is generally going to be taxable. Payments you receive for being ill or sick or injured, typically non-taxable. So unemployment, taxable as of now in full, and we'll just enter that information from the 1099-G. All right, how are we feeling with the first couple 1099 forms? Any burning questions? All right. Let's move on over into the SSA 1099. The SSA 1099 is going to be our Social Security statement. So generally what we'll probably see is, depending on what site you're at, you may see a little bit more wage income. You may see a little bit more Social Security and retirement income as we talk about maybe working at one of the homes that is more geared toward a retirement community. But the SSA 1099 is a very popular form within VITA. Good news is that it's a fairly straightforward input within the TaxSlayer program. So if you just type SSA into the top corner, it's going to take you immediately to the screen. There are going to be a couple different pieces of information we're going to take a look at. One is just to ensure is that the taxpayer or the spouse. Generally, what we're going to see is a amount in box 3. Box 4, typically in our case, is generally blank. But then we have the box 5, the pinkish, salmonish color. That's going to be the information we're going to take a look at for the net benefits for the entire year. So that's the information we want to put in to TaxSlayer. Also, an individual may have federal income tax withholding. On occasion, we do see some clients come in with federal withholding. It generally means that they either would like to have a refund at the end of the year, or they may know that they have some other income they're trying to plan around. So if they have anything in box 6, federal income tax withholding, we want to be sure that that is entered as well. In box 3, we're going to see some different pieces of information that includes the gross amount of the benefits, also how much was deducted for Medicare payments. So that could be either Part A, it could be Part B, Part C, or Part D, but those will be listed in there. And you can actually go ahead and enter those into our TaxSlayer input as well. So you can go ahead and put those directly in where it's asking for the Medicare payments. We may not really use that. That's going to be used predominantly for itemized deduction. Again, we'll talk about that in our third session, but it does make sure that we have that information just in case needed for later. We did have a question a little bit earlier today. Are there some other unique issues with Social Security? And yes, we can do something called a lump sum repayment. We don't get into it all that often, but it does have the ability within TaxSlayer. It's within scope in VITA. I believe it may be advanced certification, but if someone has been contesting their Social Security benefit, and all of a sudden they get a large payment in 1 year, which will cover some prior years, rather than have all of it taxable in 1 year, the year of receipt, we can actually go back and make a lump sum election to go ahead and take that and spread that over a couple years. But we do need to have the taxpayers' returns for those years in order to be able to make that work. The reason why I mention this is Social Security is a little bit unique. Social Security, even though we have a net benefits that'll be subject to tax, not all of that benefit may be taxable. For Social Security benefits, we're going to be somewhere between 0% and up to 85% taxability. And it's going to depend on a number of factors, including your other income or other sources of income, like non-taxable income. All of that information is already entered in the tax layer, so we do not need to do any calculations. But the individual's income can vary year to year depending on what other type of income they have. Not that we may see it all that often with Invita, but in my situation, I often see clients with changing capital gains or may have some differences in how much they've taken from retirement accounts, which could impact their Social Security taxability. But again, all we have to do is enter that information into the 1099 SSA component, and that will allow us to go ahead and have the system perform the calculations for us. All right, before moving on to our 1099-R, which is probably our largest section for the evening, any questions building up so far? Okay, I think that silence is you're either all incredibly captivated and can't wait for the next word, or I've completely confused you and you have no idea what to ask. So we'll hopefully go with the former one here. All right, we'll see how we're going. Okay, so let's get into our largest conversation of the evening, and that's going to be the 1099-R, which is going to stand for distribution from basically retirement accounts, pensions, annuities, retirement profit sharing accounts, IRAs, insurance contract, a whole host of things are reported on 1099-R. So again, a couple pieces we want to take a look at are we want to be sure we're getting the employer identification number in correctly, make sure that we have the payer identified, the person who's actually paying the money, the institution. It's going to have to be identified. And then we're going to have a couple different pieces. Again, we want to identify whether this belongs to the taxpayer or spouse. We're going to take a look at a couple different pieces on the form, including our box 1, which is a gross distribution. That's how much was in total coming out of that retirement account. We'll take a look at box 2A. That's what has been identified as a taxable amount. If we have something in there, that is great. That's generally someone else has told us how much of that distribution is going to be taxable. Quite often, like in our example here, it may be the exact same amount. You may have a couple boxes underneath there that may be checked, a taxable amount not determined, or a total distribution. Generally, that's just going to give us some indication to say 2B may be that box 2A is incomplete, and we have to do a little bit further inquiry with the client. Box 2B, total distribution means don't expect next year. That fund is completely gone. The other forms within here, the other boxes, I should say, on the form that may be appropriate are going to be box 4, which would be, are there any federal withholdings on these distributions? And in our case here, we're going to see that there is a distribution code that is not overly friendly. So hopefully the individual had some federal withholding. There may be a difference between box 1 and box 2A, and that might be something that the third-party administrator, the issuer of the form, has already indicated. There may be something that the employee has some contributions inside the plan that are going to be recovered, usually with a insurance product or annuity. So we may see a discrepancy between box 1 and box 2A, and that's completely fine. We're going to enter the information as we see it. So you may see an amount in box 5 that's not going to be used in calculation, but that can show the difference between our gross amount and our taxable amount. Now, heading into the next section is really distribution code in box 7. That's going to be critical in how the distribution is going to be taxed, not only for federal, but also for state and local purposes. And immediately next to that is a box that says IRA SEP or Simple. So what we want to do, if that box is checked on the 1099-R, we want to check that box as well during the input session. The last thing I want to just mention, and we'll get to this a little bit later, is box 9B. So that's kind of buried in there a little bit. That's total employee contributions. So we may need that coming up as we talk about the simplified method when it comes to entering information for the 1099-R. And in case you're wondering, what are these mysterious codes that I've been talking about that are in box 7? They are listed for you on D50 of your 4012. So there are a couple ones that we're going to be taking a look at. Hopefully, the best one we're going to have is code 7. It's a normal distribution. Normal distribution means that that amount we see in 2A is going to be taxable for federal, but is not taxable for state or local purposes. The one example we showed you was a code 1. That is not a great code. What that means is someone has taken money out of a retirement account early. There's no known exception to a penalty, which means not only are they going to have income tax on that distribution, but most likely a 10% automatic penalty. Again, we don't have to do much. It's going to automatically calculate within TaxSlayer. However, that also triggers the fact that that distribution may be taxable for PA and local purposes. And I'll talk about that in a little bit. For a code 2, it means that you have an early distribution. Again, that you're under 59.5, but there might be a reason why the penalty doesn't apply. That could be things like a conversion from a regular to a Roth IRA. It could be that there is some distribution you've taken, but the administrator knows that it's not going to be a early withdrawal from the account penalty situation. Again, with the code 2 for federal, it's taxable, no penalty, but for PA and local, that could also be taxable income. Code 3 is for disability. In case the recipient is totally or permanently disabled, they can now take their retirement dollars out and not be subject to penalty, still subject to tax, but not penalty. Code 4 is generally for a recipient or beneficiary of a retirement plan. It's going to be for someone who inherits a plan. They'll get a code 4, again, taxable for federal, no penalty associated even if they're under 59.5, and also not taxable for state or local purposes. A couple ones I just want to mention, code 6 and code W are now back in scope within VITA. They had technically been out of scope for a little bit, but there's really, for our federal purposes, that's not really too big of a problem to handle. We just put the appropriate code in the 6 or the W, and it's automatically going to be treating that for taxable purposes as it should. Why they're highlighted, I'll mention this a little bit later, is that there's going to be a state tax issue potentially, not on the income side, but we're going to talk about some implication for the PA rent rebate and the PA Schedule SP. Once we got through the numbers, and there's a couple letter codes that I just want to mention here. One of the big ones is going to be a direct rollover. So code G, my favorite code. What it basically means is someone has taken their money from one account and moved it to another, effectively changing a brokerage relationship. So we want to be sure that we go ahead and account for those. The one that we probably are going to have a little bit of an issue with, like I mentioned, is a code 1. And a code 1 is the opportunity for someone who has left their employment. And typically what will happen when you separate from service and you have a retirement account, someone in human resources at your exit interview will say, we have this retirement account. You have a couple options. Option 1, you can take the money and cash it out. And that's usually when they stop listening. They're like, oh, great, I can take the money and get a check instead. Their other options would be to transfer that money to a new employer account. So if they have a new job that they're going to, they can generally roll that money into the employer plan, or they can roll it from an employer plan into their own individual retirement account, like an IRA. All those would be a direct rollover. So if it goes to another employer, that's great. If it goes from your former employer to a new IRA, that's fine too. It's called a direct rollover. The problem is when you take the money out, now you're in a code 1 situation, meaning that it's a distribution directly to the individual, will be subject to the 10% penalty unless there's an exception, and will be subject to income tax. So I like seeing the numbers, but I prefer to see the letter. So the code G is a good one. Also, code H means we have a direct rollover of a Roth account. So you're rolling a Roth account from one provider to another. Code Q is that you met the qualifications from a Roth distribution, and that will not be taxable. So I'll give you some indication of what that'll look like. But I do want to mention the very bottom one here, a 7D. So a 7D, also putting in as a D7, but as we found out, for purposes of TaxSlayer to work, even if it says D7, you need to put that code in as a 7D. So just want to let you know, if you see a 7D, what that's going to do is going to be taxable for federal purposes, because it's what we call a non-retirement annuity. So it's not actually a retirement account, meaning that PA is going to treat it differently. PA is wonderful for retirees. We have some great fall weather, some nice orchards around here, the ability to smell some fresh air as long as we're not fertilizing fields. We also don't tax Social Security and retirement. However, a distribution from a non-retirement annuity, so basically a product purchased by an insurance company, is not a retirement product. It's actually an investment product. So PA takes the presumption that when you have a purchased investment product, you're going to get part of your money back. So if you invest $10,000 into annuity, over time, you're going to get your $10,000 back plus interest. So PA is going to tax that interest portion as interest on the PA return. So if you enter the information in the 1099-R and you put it in a 7D, it's going to automatically take the line on 2A, tax it to federal as a distribution from a retirement account or annuity account. For PA, it's going to pick that up as interest income. So just go ahead and put the 7D in, and it should work pretty well. Likewise, the code F is going to be for gift annuities. So a gift annuity is very similar to giving money to a charity. Over time, that they will pay you some of that money back. Any of those earnings that you have that are subject to tax are also going to be subject to interest as Pennsylvania on that return. So if you just put a code F in, automatically flow appropriately. So I mentioned on the code 4, just want to reiterate that is going to be a code designating a beneficiary of a retirement account. So they're going to go ahead and take the money that they inherited. They are still going to have to pay federal tax on it. They do not have to pay PA tax or local tax at all. And even if they're under 59.5, there is no penalty for an early withdrawal. So just wanted to mention those. Also related to PA, as I kind of indicated, the code 6 and the code W. The code 6 is really an opportunity for you to exchange a life insurance product or an annuity or long-term care insurance from one to another, generally a tax-free section under the code. But there might be a little bit of information. There might be some sort of activity that might arise into a distribution amount. For PA purposes, and again, I'll explain this a little bit more in session 4, that amount is going to be needed to be added back for Schedule SP and the PA 1000. So if you see a 1099-R with a code 6, it may have some impact on our tax forgiveness or the PA rent rebate program. Likewise, code W, same thing's going to happen. This is a taking some of your dollars that you have in a retirement or annuity account and then using those to buy long-term care insurance. Generally tax-free for federal, tax-free for state, tax-free for local, except when it comes time for the PA 1000 and the PA rent rebate. So that can have a little bit of impact there. Okay, how are we doing so far? Any burning questions coming in? Looks like we're not overly active in the chat right now. Okay. All right. Wonderful. Just assuming that we're doing incredibly well on the discussion. So a couple other things I want to mention about pensions. Yes, I'm sorry, Ed. Yep, go ahead.
Quick question. Are you going to cover the railroad stuff for?
Yes. Yep.
Okay, cool.
Yep. We're going to talk about the railroad. We're going to do the blue and the green, Ed. So we'll get both parts covered for you. Okay. So just a couple other things on the pensions and annuities. So those are going to include any distributions from a qualified retirement account. So typically we're thinking of a 401k account for most for-profit employers, a 403b for nonprofit employers. So hospitals, colleges, charities like United Way would have a 403b plan. Governments would have a 457 plan. So in general, distributions from these plans are going to be taxable in full. Mainly because all the payments to those accounts were made either by the employer or by the employee on a pre-tax basis. So all the monies going in were never taxed at all to the recipient until they actually pull them out of the plan. So the benefit we have here is it's going to be easy for that distribution. Distribution should be fully taxable. Again, if there is something on the line 2A, which I mentioned might be a little bit different, we just enter the 2A. But the expectation, something coming from an employer plan, is going to be fully taxable. So we just want to talk a little bit about how our expectations are. I'm going to talk a little later of what happens if there's nothing in the box 2A and what our resolution can be there. Now, you may have clients that are public safety officers. So a public safety officer is basically someone who's been in law enforcement, a firefighter, a chaplain, member of a rescue squad or ambulance crew. Typically, what their benefit plan allows them to do is to use some of those retirement funds and go ahead and buy additional insurance. So if they buy things like health, accident, and long-term care insurance premiums, they can actually have a reduction of taxable income. And it's going to be the smaller of the amount that they actually paid for insurance, or $3,000. So very, very detailed description in your 4012 on D45 if you run into those scenarios. Most individuals will identify that they have a public safety officer insurance. They will generally have a letter. They'll have a pamphlet coming from their benefit company to say how much they paid in insurance benefits. And if they do have that, we can just go and follow the instructions on the D45. It's simply to click on a additional information, click on your taxable account button, and then we'll enter the PSO appropriately. We're going to also talk a little bit about our taxable amount on 2A. Like I mentioned, we can use a simplified method or a general rule, and I will be spending a little bit more time talking about that in just a handful of slides here. So just want to kind of go through a couple quick pieces on that 2A first, and then we'll get into our simplified method. So the good news is if we have an amount reported in 2A, enter the amount in 2A. That's what's coming from the third party administrator. That's what's going to get reported to the government. So we do want to go ahead and report the amount on 2A in the 1099-R input. That'll allow it to carry over to the appropriate line on the return. If there is no taxable amount in box 2A, it may say unknown. It may have another feature about it. As long as the individual has made only pre-tax contributions, generally how those are intended to be, then that distribution is fully taxable. You can go ahead and allow that to either come over as a full gross distribution, or if you want to, you can go ahead and put that amount in on 2A to make sure it's coming over appropriately. But that generally is what we would expect to see coming from employer plans. The reason why it may say unknown, again, you may have had an account transfer over, so they don't entirely know whether or not there was a post-tax contribution. So what you would need to do if you're getting one 1099-R and line 2A is blank, you can ask the taxpayer, are you aware if you've made any basically after-tax dollar contributions or post-tax contributions to your retirement account? Generally, their look will be completely blank because they have no idea what you're talking about, which is good because most employer plans are not generally allowing you to make what we call an after-tax dollar contribution. Most of those are going to be done with salary deferral. Money's coming in from the employer, earnings on the account, so the entire account should generally be taxable. If they come back and say, oh, no, I did make some after-tax or post-tax contributions, then unfortunately, we cannot prepare the return at VITA. Those calculations are relatively complex, something that we don't have the ability to do within the VITA program. And most professional tax preparers don't like working with those either. A little bit of a hassle to go through the calculation. But unfortunately, that'll be outside the scope of VITA if we have to make a taxable calculation. Okay. Excuse me. Also kind of following in the retirement distribution line are also Roth IRAs. So Roth IRAs are beginning to kind of come to the forefront here at VITA as we start saying some people may have started accounts a couple of years ago that might be now looking at making distributions. The nice part about Roth accounts is that they are generally tax-free. So that includes not only the money you put in, which is always tax-free coming back, but also any of your earnings in the plan would also be tax-free. And you have to meet a couple qualifications. And again, hopefully you're going to get the great code we're going to see here on the 1099-R to indicate that your Roth contributions or the Roth distributions are completely tax-free. So the basic rules are you have to have held the account for 5 years. So you have to wait until 5 years after you first open the account. Distribution has to meet one of the following conditions. You've reached age 59 and a half. Due to disability, you are a state beneficiary, or that you're going to pay certain first-time home buyer expenses. If you did not meet those tests, we're going to have a partial taxability. Again, your contributions come back without tax, but the earnings are going to be taxable. It's a little bit of a complex calculation. Again, hopefully we don't see those. Generally, if we have those nice clean codes, we'll be in good shape. So hopefully we don't see those. If they are, again, we'll have some issues preparing those returns and we'll have to send the client away. If there are any questions, feel free to talk to your site manager. about what that can look like. Okay, so again, the basic premise: if 2A is blank, hopefully we ask the client, did you make any after-tax or post-tax contributions? Their answer is, I have no idea what you're talking about. That's perfect. We're going to go with the presumption fully taxable. But there is another alternative. There can be plans in which the employee has contributions. I've typically seen these in terms of government plans where they're making additional contributions. So what we're going to take a look at, if you remember back, I mentioned on the 1099-R, there was a line 9B. This is where the 9B may be coming into applicability. There may be some investment in the retirement contract. So any of those premiums that they paid or contributions or other amount generally are going to be reflected on 9B in the first year that payments are received. So the first time they've opened up their retirement distribution, the total amount that they have in investment in the contract will be shown in 9B. Now, a method that we can utilize and works very well within the VITA program in TaxSlayer, it's often hit on the exam that you'll need to take for certification, is what we call the simplified method. So the simplified method must be used in one of two cases. So if they started the annuity after July 1st, 1986, and we've used that for prior years, you have to continue to use that. If the annuity started after November 16th, 1996, and both of the following conditions exist, the payment's going to be from a qualified plan. So it's a qualified employer plan, or it's a plan annuity, or a tax sheltered annuity plan, a 403B, and the recipient is under 75, or the amount of years that they're going to take that over is 5 or less. If those rules apply, we can use simplified method. Generally, almost everyone coming in that has this type of situation, we can use simplified method. If for some reason the simplified method cannot be used, we can move to what they call the general rule. The general rule method is spelled out in publication 939, a little bit more complex. Again, we'll want to take our time preparing that return. Simplified method is actually as it sounds. It is a relatively simplified method for going ahead and preparing the 1040. So if we've already used the simplified method, we need to take a look at that prior year return. It's going to show the calculation of what we've been taking as part of our investment in contract. If we're doing this for the first time, we'll need some additional details of that annuity. That includes their the date the annuity started, and also whether that payment's going to be made over a single life or joint life, or potentially if that's going to be over a set period of years. In most cases, that annuity is going to be paid either over a single or joint life. The other thing we need is the age of the recipients whenever this annuity started. Good news is you do not need to ask for a date of birth once again. We already have that when we had done the intake process, and they're already into our system. So very cleverly, you can go ahead and double check their date of birth from their records that they're providing to you, verify that with their ID, and you don't need to ask for their date of birth again. So I mentioned that our investment in contract is going to be shown in 9B in the first year of distribution. That number is going to be important for us going through and entering it appropriately into TaxSlayer. We do not need to go through and do a table calculation. There are a couple that are available in our publications for reference purposes only. For taking the exam, I recommend that you do the practice lab and do the simplified method within a practice return. We're going to go ahead and use in the background these IRS annuity tables. There's also another method. If the annuity is just for a period of years, we have to use a different table. We are hopefully not going to be in that situation. But I just want to run through how the simplified method would work. So, and this is actually an example taken directly from our IRS materials. So in addition to the 4012, the publication 4491 is also a very helpful compendium, which will go through some more detailed examples. And I believe, as Kim confirmed, that that is now available for this tax season, which is a great way to get some additional information. If you're going to be taking a look at some more complex areas, or you're struggling with one portion on the exam, a great resource to kind of very clearly spell out how these examples should work. So what we have here, we have Bob Smith, age 65, began receiving retirement benefits in 2023 under a joint and survivor annuity. So Bill's starting date is going to be 1/1/2023. Benefits are paid jointly for him and his wife, Kathy, who also is 65. Excuse me. Bill had contributed $31,000 to the plan. So that's what would be shown in line 9B of the 1099-R. Has not received any distributions to date before 2023. He's going to be receiving $1,200 a month. Kathy's going to get half that amount if she survives Bill. So the first question we have, should a simplified method be used? And this is generally where we meet in person. Everyone yells, yes, it should. And then we explain why. Yes, it should, because this is an annuity that is from a qualified plan. Bill is under the age of 75 when this plan has started, and it's going to be payable over the joint and survivor annuity plan, so both lives. So all we have to do in this case is enter this information in a tax layer. The amount of the investment in contract, the $31,000, is going to know that it's a joint survivor annuity, and it's going to automatically calculate our taxable amounts. Now, you could do this if you wanted to. You can actually go through the tables from the IRS materials and determine how much it is. In this case, we take a look at the joint life expectancy. The factor we're going to have is 310. So the way this would work is we take 31,000 divided by 310, if you'd like to do this by hand, and you come up with $100 a month. So the IRS annuity tables assume that Bill and Kathy are going to live for 310 months after they start the annuity. So we'll be able to recover $100 of his $31,000 investment each month. Again, the tax layer system will automatically reduce that $1,200 per month by the $100 that he's allotted under the simplified method. So that would allow that to be recovered. If both Bill and Kathy would die before the full amount's recovered, we can take a final amount on their final income tax return. Generally, we probably don't get to that stage. All right, questions on the simplified method. That can be a little bit of a sticky issue, and it is on the exam, so I know that it is covered, and just want to be sure we're giving you enough information and resources to be able to tackle that question. Again, basically looking at our joint or survivor benefit, when the benefit started, and the 9B investment in contract is what we need to know. Okay. Well, let's hop back into this early distribution from the retirement plan. Want to kind of go back to this. This is effectively what I call the tissue box code, because generally when you see a 1099-R coming in and you see a code 1 in box 7, it may indicate that the taxpayer who may have been expecting a substantial refund may be unpleasantly surprised by the fact that not only do they owe income tax on their distribution, they owe a penalty of 10%. And not only for federal, but that may also be taxable for state and local purposes. So what we basically will do is have the client come in. We'll see that they have a 1099-R. They'll present it, and we'll see that there is a code 1 in box 7. You may want to inquire. So it looks like you took some money out of your retirement plan. They're going to say, yes, I talked to HR, and the only thing they told me is I can get cash. Well, they probably told you a couple other things, but you stopped listening when you heard you can get cash. So be it. That's fine. You can take the cash out. That's entirely their decision, but it is going to be subject to federal income tax and an automatic 10% penalty. We don't need to do anything else other than have the information exactly on the 1099-R into the input. So as long as the code 1 is in there, it's automatically going to go to federal. It's automatically going to get hit with the 10% penalty. I will talk about the exceptions to the penalty in just a minute. But if there's no penalty exceptions that exist, that's all we need to do for federal purposes. Now, I mentioned there's another downside, and that is that the early withdrawal is also subject to Pennsylvania and local taxes. So that would be reported as other compensation on the W-2S. It will flow over to the compensation line. For local returns, however, you need to add that as other income. So it will not automatically flow to our local return. You have to add that in as other income. Now, the only benefit that we have with an early distribution here is that Pennsylvania and local follow what we call a cost recovery method, meaning that any distribution you have is first treated as non-taxable to the extent that the employee made contributions. And we also mentioned a little bit earlier that you ask the employee, did you make any after-tax contributions? They have no idea. If you ask them, how much did you contribute to your retirement plan? Again, they may not have much of an idea. But fortunately, we can use documentation that we have on hand. So when we take a look at that W-2, if we see a code D or a code E, In box 12, that's how much the individual contributed that year for the retirement plan. So they may want to go back and see how many years did they work at that employer. Do they still have the W-2s or copies of the returns that we can take a look at and identify how much did they contribute to the plan. So if we go back and we see that their W-2 over this year and the prior year had shown $800 of contribution to the retirement plan, and their 1099-R is $1,200 with a code 1 in box 7, we're going to take the $1,200 of federal taxable benefit, but the first $800 that they contributed personally are not taxable for PA or local. So we're going to make a reduction of their taxable benefit for PA and local and only represent the $400 that have come either from earnings or employer contributions. So the benefit for PA is you can recover your cost first before it becomes taxable. This will take a little bit more time to go ahead and do that calculation and get that into the system appropriately. However, I'm pretty sure the client won't mind because it will save them tax dollars. We can always go through and say, I don't know what it is. The government will give us a clear answer on how much that'll be, and that answer is 0. If you don't give them the basis, they're going to assume that there were no contributions to the plan, which is not accurate. So it may be beneficial for the client to walk through and determine how much their cost recovery amount is. Now, I did mention that we do have penalties associated with early withdrawals. There's also a couple exceptions to those penalties. So a couple of those penalties we want to take a look at here are going to be a conversion from a regular IRA to a Roth. That'll be indicated within a code 2 in box 7, so that's automatically taken care of, even if they're under 59.5. You could have a rollover. So the best way to do a rollover is direct from trustee to trustee. If for some reason the taxpayer says, I prefer to get the check and then I'll take the check and give it to my new broker, that has to be done within 60 days. So it's 60 actual days you get it, not 60 working days, not 60 non-holiday days. It is actually 60 days. So it's a pretty firm deadline. And within 60 days, it has to be back into the new account. If that happens, the taxpayer says, I've done it, we'll take them at their word. Typically, they may need to bring a 5498, which is another form to show a contribution that may help justify that they made that contribution in. We can tell TaxSlayer it's a rollover. So typically the 1099-R is going to give a code, something other than a code G, but we can tell TaxSlayer it's a rollover and it's going to be treated as non-taxable for federal, state, and local purposes. A couple other things in code 2 could be a withdrawal from the account due to the IRS seizing the account. Could be from the death of the IRA or the retirement owner. It's a code 4. There may be some situations for permanent or total disability that could be non-taxable. I'm sorry, not non-taxable, non-penalty oriented, still taxable, but no penalty. So that could either be a code 3, or we may need to make a code in a 5329. If there is a valid reason why the penalty should not apply, if they're going to meet one of the requirements I'm going to talk about in a minute, we can use the form 5329 to go ahead and alleviate a portion of that or all of it from penalty, not from tax, but from penalty only. So there's a special section within our TaxSlayer. We can go to other taxes, tax on early distribution, and whatever amount that is not subject to penalty, we can go ahead and enter that in on early distribution, not subject to 10% tax, and then select the appropriate drop-down box for the reason for exemption. Now, you may be asking, what are those codes? Well, those codes are going to be found on H6 of your 4012. The most common ones are going to be used are really not a whole lot with Invite. I don't think there's really a lot of people saying, I pull the money out of my account to do the following items. But there is a list of codes available. Part of it could be a code 05. If they pulled money out of a either IRA or their retirement account to go ahead and pay for medical expenses. So that's anything that's in excess of 7.5% of their adjusted gross income, meaning that they would have had medical expenses generally greater than 7.5% of what we call gross income. Now you'll see the next couple codes, code 7, 8, and 9, are all related just to IRAs. So again, we need to pay attention to if that IRA SEP or simple box is checked on the 1099-R. And if they are, then maybe 7, 8, or 9 could apply. 7, not so much that we usually see. It's going to be health insurance for unemployed individuals. So that could come into play, although there are a couple other ways in which people could get health insurance. Code 8 would be, again, an IRA withdrawal to pay for college expenses. So that includes tuition, fees, books, supplies, qualified room and board. You do have to reduce that by any amount of scholarships or non-taxable assistance you may have received. Again, I don't think we see that all that often within VITA. Likewise, a code 09 is a IRA distribution for first-time home purchase up to $10,000. The IRS first-time home buyer does not mean your actual first home. It means your first home that you bought in a while. So doesn't mean that it has to be your very, very first home, but if you've been renting for a while, it may count for a first-time home purchase. So again, we'll have to take a look a little bit more in depth, facts and circumstances with each taxpayer. The other one that could apply could be Code 19. And Code 19 is actually for $5,000 from an IRA or from another retirement account, up to $5,000 for the birth or adoption of a child, generally within 1 year of the child being born or adopted. So again, we'll alleviate penalty only, not the tax. So very well could be subject to tax. We may not get all of the penalty relieved. For example, if they take $15,000 out, only $10,000 can be used for the purchase of a new home. So it is available. We do have that ability to work with the 5329, but we probably just want to have a little bit of caution as we're going through that process. All right. And just for Ed, wanted to go ahead and make sure we're covering the railroad benefits. So on D57, we're going to be talking about two different railroad retirement benefits. So we're going to have what we call the blue form, which is a tier 1, which is a 1099, I'm sorry, an RRB for railroad retirement benefits, 1099. So that's what we call the blue form. You'll enter that information in TaxSlayer just like it's a Social Security statement. So the blue form, the RRB 1099, is going to be entered exactly like Social Security. In fact, you'll go right to the indication here, the income 1099R, RRB, SSA, Social Security benefits 1099 RRB 1099, sorry, and or go to the keyword SSA. So enter those exactly as you see it. They may also have tier 2 benefits, which we call the green form, and that's also a different form. That's going to be an RRB 1099-R to make that completely confusing. But we have two different ones. Blue is going to be treated like an SSA. Green's going to have its own separate entry point here. So we're going to go to the RRB 1099R, or you can use the keyword RR to get to that exact spot. It makes you sound a little bit like a pirate when you say it. But those are our Social Security and railroad benefits. Any questions so far? I know we've spent a lot of time going over Social Security, retirement, and now railroad benefits. Any questions so far?
Jared, I have a quick question, I think.
Yeah, Barry.
On a 1099R, what would keep the payer from not providing a figure in box 2A for taxable amount?
Yeah, great question. So usually what may happen in that case, Barry, it may be that the third-party administrator, and typically it might be an IRA holder or IRA provider, may not know if you had any or sort of non-taxable contributions made to the account. So if it was rolled in the account, they may not be aware if there were any, and to be on the safe side, they're going to put either unknown or just leave that blank. But generally, you're probably going to see something in 2A. It could also happen, obviously, when we have that simplified method, when you're getting a distribution from the first time and they know that you have an investment in contract, it'll generally show as unknown. A lot of my government retirees, it'll show up as unknown in box 2A, again, because we might be using a simplified method even after the first date of the distribution. Typically, 2A will be filled in, but the exceptions that I usually see, Barry, is that they don't really know whether or not that you had any items that could be considered non-taxable coming out. So to be on the safe side, they're going to say, go ahead and you do the research on it a little bit more. But typically, it hasn't been a problem with VITA. I don't believe we've sent many people away because the box 2A is blank and they don't know if they had any after-tax contributions. The answer is generally, I have no idea what you're talking about, which means let's go fully tax it. Right. Does that help out a little bit?
It does. Thank you.
Okay. The other situation, like I mentioned, sometimes it is different, and those can be from an annuity type benefit. So not everything that you get from an annuity is going to be taxable income, but they're going to calculate how much would be. So 1 and 2A don't have to match, but that could be a slight variation as well. Okay. So how are we feeling here, Kim? We have about 10 more slides to go. Should we keep working our way through?
I would say go for it unless anyone
Okay.
would like to take a break, but
Okay. I'll let you kind of take your break. Kim will be around to refill coffee and waters at your house if need be. But if you need to take a break, by all means, go right ahead. I think we'll continue to go through. Again, if you have any questions, feel free, put them through chat. Go ahead and raise your hand. I think Kim is doing a very diligent job of making sure that I'm staying on pace here. So be able to grab me in case we want to talk about anything as we go through. Just last couple issues we want to discuss this evening are related to areas of capital gains and loss, and we're going to talk about some other income items as well. So capital gain and loss, this used to be advanced certification only, but we're seeing a little bit more of capital gain activity. So we're going to encourage and have this part of our normal training process. So capital gains and losses are going to start in section D32 of your 4012 and go through quite a few pages. So what we're going to be taking a look at here is mainly the input section is what we're going to be concerned about. The information we put in the in TaxSlayer is actually going to go to a couple different forms. One is the 8949. That information's reported and then summarized and then comes back up to what we call the Schedule D, which is then calculated. Again, we mentioned we have some special tax rates, and then that goes back up to the Form 1040 as other income that gets added to your adjusted gross income. Now, the transactions that are still within scope for VITA are going to be things like the sale of stocks, sale of mutual funds. Generally, those are going to be reported on a 1099-B coming either from the company itself or through a brokerage account. Also, that could be applicable is going to be a sale of a personal residence. So generally, that will not have to be reported, but in case you get a 1099-S, we absolutely need to get that information in on the tax return. So we do need a couple pieces of information in order to accurately complete any sales of property. So we need to understand what the sales price is. We're going to talk about the adjusted basis of an asset, and I'll go through the information we need for that. Generally, that's going to be provided to us by the broker. If we have a sale of a residence, I'll talk about what items will be included in there. If you want additional information, Publication 551 is an excellent resource for going through the details of basis related to property. We're going to determine if this is a short term, meaning that it is sold within up to 1 year of being acquired. If it's sold beyond 1 year, it's going to be long-term holding period. And again, the main benefit for that, if anything over long-term, is subject to special capital gains and qualified dividend rates, generally for people eligible for VITA. Again, we have actually now increased our threshold now up to $70,000 per year. So we'll widen the net a little bit bigger here within Lancaster County to provide services to even more taxpayers. But generally, anyone eligible for VITA is going to be in the 0% long-term capital gain and qualified dividend rate. Very, very nice benefit. We need to understand, are there any capital loss carryovers? And we usually get that information from taking a look at the prior year return. If they're a returning client to VITA, that information will automatically carry over. It's generally new people coming in. We want to take a look at their return, and they will usually mention if they have capital loss carryovers. I'll also mention about our principal residence exclusions a little bit here, just so everyone's aware of what those rules are going to be. So as I mentioned, the main thing that's going to trigger a capital gain or loss transaction is we're going to get a 1099-B. That'll be for our stock and securities, again, generally from the company or from a investment account. If we have a sale of a real estate, that could be coming off a 1099-S. Anything with a 1, a 0, and 2 nines in it, we have got to get that on the return. That way the government's going to have all the information they need to help process that return accurately and correctly. I had a client, or I have a client technically, who had been preparing her returns on her own for a couple of years. She had gotten divorced from her husband. They sold their house. The 1099-S had never reached her because she had changed her address and it was mailed to the incorrect area. She was not aware that there was a 1099-S floating around until the government came knocking at her door, tracked her down and said, "We'd like to talk to you about the amount of money you owe us." And we had to go back and file an amended return to show that the proceeds from the sale of the home were not actually taxable. And she did not owe the IRS over 6 figures in tax. So we wanted to alleviate those concerns. But if you have the 1099-S, be sure it gets into that income tax return. So we'll have the information. Generally, the 1099-B is going to show our sale date, our sale proceeds. The ones coming from brokers will also show typically the purchase price and also the purchase date. So we can actually put these in the correct category. We're going to take a look at the summary of information. Again, for capital gain activity, if you have a brokerage statement, you do not need to enter every transaction. If they have summarized the transactions for you and all the information's there, you can actually enter it into summary form. So short-term capital gains is covered securities or one line. Short-term capital gains, non-covered securities can be another line. Same thing with long-term, we'll have covered and non-covered. So if all the information's there, we can enter it in as a summary. We don't need to enter each and every line in on the tax system. It can take quite some time to type them all in. And the other issue we run into is an inadvertent miskeying of information can lead to an inaccurate result. So generally, we recommend, if possible, do a summary information.
I have a quick question,
Sorry,
Jared.
yep, go ahead. Yep.
So how long can a capital loss carryover be used?
So a capital loss carryover actually is indefinite. So what we take a look at from a capital loss perspective, if you have more capital losses in 1 year than capital gain, the IRS will allow you to use up to $3,000, unless married filing separately, but generally $3,000 of capital losses in excess of capital gains can be used to offset ordinary income. Any amount above that $3,000 is carried forward indefinitely until the taxpayer passes away. So that is that at that point it terminates, but you can use $3,000 a year until it's either absorbed by future capital gains or you use up that $3,000 per year. Okay, did that help answer the question? Okay, perfect. Good. So fortunately, in most accounts, the broker will provide basis information. Most of the securities that are probably being sold now are held at the broker long enough that they understand what the basis is, so they can report that for us. But if it is not reported, and we sometimes see this, particularly with people who may have had securities for quite some time, we may have to go back and get that information. But we can't give the client basis information. The client can't say, what do you think should be my basis? Well, we can't give them that information. They can ask the IRS what they think their basis is, and the IRS will give them a nice round number of 0 for basis, which is probably not the correct number. So if we run in a situation where someone doesn't know what their basis is, the best rule of thumb is to have them go back and talk to their broker. The broker may actually have that information, be able to provide it. Sometimes if they have a relatively longer brokerage account, if you take a look at some of the information in the back of that brokerage statement, it may actually have basis listed for you, even if they didn't report it on the front pages. So you may want to just thumb through that a little bit. But again, we cannot provide basis information. That has to come from the client or their broker. So once we know the original cost of the asset, that's our original basis determination. If we have something like real estate, anything that gets added to basis would be our closing costs, like our real estate fees, our commissions, our brokerage costs. If we have any types of improvements to real estate. So if you've added on a new room or renovated a bathroom, those actually count as improvements. Generally, brokers, like I said, will put the basis information on a 1099-B, and then we'll use the 1099-B to use that information to enter in a tax layer, and we'll take a look at the codes, whether it's covered, meaning that basis information has been reported to the government, or non-covered, meaning we have basis, but that was not reported already to the government. So again, we'll just kind of put that information in. Short-term, like I said, is basically anything held for 1 year or less. Long-term is anything over 1 year. The long-term capital gains are going to get us a preferential tax rate. Some questions do arise at times where if someone has been gifted property, so if someone has given them some stock, how do they determine their basis? Well, their basis in stock in a gift is the exact same basis that the person who made the gift would have. So if I had stock, it's worth $1,000 and I have a $600 basis and I gave it to someone and they sell the stock, For $1,000, you're going to have a $400 capital gain. So the 1,000 minus the 600 a basis, $400 a capital gain. What happens if we pass away? So if instead of me gifting them the stock, I give them the stock in my will. So now what happens in an inherited situation, the basis in the stock will become the fair market value of that stock at my date of death. So if I had $1,000 worth of stock and I paid $600 for it, the person inheriting my stock at death will get it for $1,000 a basis. So if they sell it, there's no gain or loss at all. Not to say people would prefer me to die over getting a gift from me, but from a tax perspective, they probably would. So that is just how we take a look at basis rules when it comes to gifting or inheritance. For the most part, like I said, from a 1099-B perspective, they're generally straightforward. I have had clients that have sold stocks that they've held since shortly after World War II, and then that becomes a little bit of an issue to go back and get the basis. Generally, we have to have the broker go back and do some research for us. One last thing I want to mention about the sale of a property is the sale of a personal residence. So again, more information on the D38. Generally, the sale of a home is not reported. However, if they do get a Form 1099-S, or if they do not meet the exclusion rules, which we'll talk about in a second, then we have to report the sale of a home. The exclusion rules are actually fairly broad. They actually work for both federal and state purposes. So what we're looking at is in a 5-year period. So 60 months before the home is sold, did the taxpayer own the home for at least 24 of those 60 months? And do they occupy the home as a primary residence for 24 of those 60 months? So they don't have to be simultaneous. And if you take a look at the 4491 publication, they have some very unique examples that kind of have differing time periods of when you own it versus when you live in it. We don't get that complex. Generally, we take a look, have you lived and owned the home for at least 2 of the last 5 years? If that's the case, then you're eligible for the exclusion. So for married filing jointly, it's a $500,000 exclusion on gain. And not just the proceeds, but that's gain. Did you gain more than $500,000 on the sale of your residence? If you're not married, it's $250,000. So kind of quick rule of thumb, if you've lived in a home for the last 2 of 5 years, and you've owned it for the last 2 of 5 years, and you're married and you sold it for $325,000, good news, you do not owe anything on the sale of your home. Generally, if that's not even reported on the 1099-S, we don't even have to worry about it. But if we do get a 1099-S, we do have to report it on the return. Likewise, if they don't meet the home exclusion, there may be partly taxable activity, but that's going to go for both federal and PA. Most cases within VITA, we're looking at people who are downsizing, maybe moving from their home into a retirement community, and generally have met the 2 of 5 year rule. Again, $250,000 of gain. So even if you sold your home for $325,000 as a single individual, if you paid $100,000 for the home and you had, say, $20,000 of closing costs, you're going to be fine. You're going to be under that $250,000 exclusion level. So within TaxSlayer, and again, there's some very good detail on the D38 of how to enter that into the TaxSlayer program. Again, we do want to mention the selling price will be found on the closing statement, the HUD-1 or the 1099-S. We do get to deduct any of the costs for selling the home or even buying the home, the commissions, transfer fees, all the other things, plus costs of improvements. All right. How are we feeling on sales of property?
Hey, Jared,
Yeah.
how often do you actually see a 1099-S?
Not
I mean,
very.
typically, I mean, if they know it's your primary home, are they going to really issue that frequently?
They typically do not. So generally, it's going to be either the title company or someone else issuing the form. If they know it's a principal residence and they know that generally that the sale price isn't going to be anywhere close to the possibility of a taxable gain, they will not issue a 1099-S. Generally, we'll see 1099-S on something that may be considered a secondary property, rental property, investment property. But generally, if they know it's a personal property, we do not see 1099-S. And I don't think, as a matter of course, there's many coming through in the VITA program. So does that help, Ed? We don't really see many of those throughout VITA.
I think in the time I've done this, I don't think I think maybe seen 2 of them.
Okay. And is
Yeah.
that
Thank you.
I have a question in the chat, Jared.
Jared,
Oh, sure.
I'm
Yeah.
sorry, can I can I ask my question first? Because
Go
this
ahead.
is Annette.
Yeah, go ahead, Matt.
Ed, thank you for your question. I did see one of those, a sale of a residence, where the client did not receive a 1099-S, but they brought in all of their closing documents from the sale. And they said they just didn't receive one of those. In that particular case, should we go ahead and enter all the information that they provided, or not go through that exercise? And in this particular case, there wasn't a gain on the sale, but the
Okay.
client was diligent in bringing in all the paperwork.
Sure. And certainly Annette, no problem if you do want to enter that in. Again, you can follow the D38 and report it. What effectively happens, it shows up a sale of a principal residence. It's going to show the sale price, and then your cost is exactly the same. So basically, it just shows it's a home sale exclusion. I believe puts a special code on the 8949 to indicate it's a sale of a principal residence. So in that case, they probably did not receive a 1099-S, but sometimes better safe than sorry. If they brought all the information in and we can easily prepare that, my advice would be take a couple minutes and get that in the return to avoid that. But typically, as Ed mentioned, they won't issue a 1099-S to all parties, but everyone does get a copy of what they call the HUD-1 or the settlement sheet, or at least seller's closing documents. It's probably a really thick packet that they might bring in, but generally it's a 1099-S is going to cause a problem. If they think there might have been one, or they think that there could have been one that may have been issued and they just didn't see it, again, you can go ahead and enter that, but we don't need to do that for every transaction if they're being told they're not going to have a 1099-S issued. But certainly, Annette, if you want to go ahead and put that in, that would be fine too. Did that help out at all?
Yeah, it did help. And
Okay.
the client, as I said, brought in all the paperwork, so it was a fairly quick exercise.
Oh, good. That's always
Okay.
great to hear.
Good.
Okay.
Thank you.
Yep, absolutely. Okay.
All right, so the question that was on the chat, if you have a gain of 50,000 this year, can you offset the capital loss balance from other years?
Yes. So if you have a capital loss carry forward, that's going to go ahead and offset your capital gains from the current year. So if you have, say, a $10,000 capital loss carry forward from prior years, and you have 50,000 in capital gain this year, it's going to bring your capital gain down to $40,000 reportable. The downside is you can't do it the other ways. You can't have 50,000 of gain and then have losses and say, can I go push them back to the prior year? That doesn't work. But certainly you can offset your capital loss carry forwards with any capital gains that you might be taking a look at. It's a great strategy. Sometimes we take a look at that if we know we have a lot of capital losses. Maybe we take a look at your investment account and try and get some sales in there. Again, we're not doing tax planning with Invita, but a good opportunity to try and utilize those capital losses if possible. Just one word of caution. PA does not follow those same rules. They do not have a capital loss carry forward. If you have a loss in 1 year, you lose it. So no carry forward for PA, but there is for federal. So absolutely, if you have $50,000 or a large amount of capital gain in the current year, that can be offset with prior year capital loss carry forwards. Okay. And anything else?
Actually, can I I want
go ahead, Ed.
clarification for that, Jared. So you can't carry over. Okay, you carry over 3,000 a year. Is that only against net capital gains, or is it? Can you take more than $3,000 of a carryover net loss? So you carry over, let's say, 10,000 from last year, and like you said, the 6,000. Can you deck 6,000 of the prior year loss against that 6,000 gain this year?
Absolutely. Yeah. So the 3,000 we're talking
Okay.
about, Ed, is really the net loss over gain. So if you have maybe for argument purposes, let's just say we generated $9,000 capital loss for 2023. So with that $9,000 loss, I can use 3,000 on my 2023 return, and 6,000 is going to be carried over to future years. If I don't
Perfect.
have any capital gain in the next 2 years, I'll use 3,000 per year until that's expired. But if in 2024 I have, say, 7,000 of capital gain, I'll offset my 7,000 of capital gain with my 6,000 of capital loss carry forward, and I'll use all of it up at that point. So the 3,000 is
Gotcha.
really just how much in excess of capital gain can I use. So even if I don't have any capital gain, I can still use $3,000 to offset my other income.
Right. Okay. Yeah, so you'd either have to have the return would have been done at your site, or you'd have to have the return to know what the carryover loss is then.
Correct. Right. Yeah. And usually only really applicable in the first year of someone coming into to VITA. So hopefully we just pick that up on a Schedule D if they have it, if they have the capital loss carry forward.
Gotcha. Thanks.
Okay. Sure thing. Wonderful. Okay. All right. And let's see. Oh, great. Okay. Looks like we have a question coming in about gambling gains and losses. That is an excellent question. And we'll be covering that in approximately 13 and a half minutes. Or maybe faster, but I've been told I need to slow down at times with talking. So we'll see how I do here with getting that together. But we will definitely be covering gambling losses and winnings, and take a look at a couple different things there. So great question, and I will be covering that in just a few slides here. So if no other questions on gains, I'll switch over to business income. And business income, again, was a advanced topic in years past, but we wanted to go ahead and do kind of general training here to make sure everyone is aware of what we mean by business income. We're seeing a little bit of an uptick in individuals who are doing some work for employment or work for additional cash on the side. Depends on what you want to call that, a side business, side hustle, side gig, any of those other types of things, depending on what generation you want to call it, or for most people, just working harder to get some extra money. Generally, what we want to do is report any of these activities on a Schedule C. So this could be anything from people who are providing babysitting services to lawn mowing on the side, maybe helping to do painting or general contracting work, fixing up decks or doing some installation of patios, working for Lyft, Uber, or any of the delivery services are typically going to be considered self-employed individuals. So if you are not having a W-2, if you're not getting a regular paycheck with withholding, with Social Security and Medicare taken out, we're typically going to consider that as self-employment income. So when we take a look at business income, again, D21 of your 4012 will give you some more information. All of that will ultimately be reported on Schedule C. So we'll show you a couple different ways that information can get there. But also want to mention to you another benefit of Schedule C employment is the government will give you a 20% deduction automatically just by being self-employed in the U.S. TaxSlayer will automatically calculate the Form 8995A, which the QBID is Qualified Business Income Deduction, automatically calculated. So if I make $10,000 of a side business, the 8995-A will calculate and give me roughly a $2,000 deduction I get to use on my return. So it's going to reduce my amount of taxable income. It will not impact my self-employment income, which is going to be based on my net business earnings. So we can prepare returns in VITA under the Schedule C rules. Generally, a couple limitations we have. So those business expenses cannot exceed $10,000. We're not going to be here preparing returns for things like a mom and pop pizza shop or a repair center. So we're not going to be looking at kind of extensive business activities. Other things we can't do are have activities that have a loss in the business. So that's outside the scope of VITA. And mainly because there are some rules we need to take a look at to make sure that it's actually engaged for profit and we're not artificially creating deductions that may not exist. So the loss from a business is kind of an IRS kind of position to say it's a hard stop there. It doesn't make sense if you're saying I'm going to deliver newspapers for $100 a week, but I'm going to take $5,000 a week in mileage. So we can't have a significant loss like that. Likewise, we cannot have a business with employees. We do not provide payroll services or W-2s. For the next two items, cost of goods sold and returns and allowances, we cannot have inventory. So does that mean we can't handle someone who has some Etsy crafts that they're selling? No, we can absolutely handle people who handle Etsy. We're not going to be handling grocery stores. We're not going to be handling convenience or retail locations. So you can't have items you're buying and reselling that we're accounting for them as inventory. So that doesn't work. Likewise, even though here in Lancaster County, PA, we cannot do farm returns. So not something that the IRS has given us permission to do. We cannot do depreciation. So if you have large equipment, if you have a lawn mowing business and you have substantial pieces of equipment, several $1,000s worth of lawnmowers, we cannot take depreciation under the VITA rules. So we cannot use that, even though they have some opportunity within TaxSlayer, cannot be done with a VITA client. Likewise, home office deductions are not allowed. So we can't do those. And self-employed health insurance, a little bit more complex. So that's also not in our purview. Generally, when people are calling for appointments, their 211 service will screen out and ask a couple questions, and they usually do a very good job of that. Every once in a while, someone's going to say, oh, I forgot to mention to them that here's some business activity. If we cannot get them to meet the qualifications, we unfortunately cannot prepare the return. And again, if you have any questions about where they're falling, it's probably best to first check with your site coordinator, and then we'll kind of move that up the chain. So I want to mention a couple different factors here with business income, and there are a couple different sources we'll talk about, and a lot of those are listed here in the Form D-22. So one of the things we're going to first look at is if an individual receives a 1099 NEC. NEC stands for non-employee compensation. So this is oftentimes coming in if an individual might be operating a cleaning service and might be working for businesses after hours. They will generally, as a business, report an income on a 1099 NEC. Obviously, the government's going to get a copy. We need to report that on the income tax return. The non-employee compensation is generally in box 1 of that form. We can enter the 1099 NEC in tax layer. It's in the federal section under income under Form 1099 NEC. And then you can actually link that to a Schedule C. And there's a screenshot on D23 that shows exactly the entry and linking process. There may be a Form 1099 miscellaneous still floating around. We had a question earlier this morning that an individual was still getting 1099 miscellaneous for self-employment income. Technically, that should not be the form used. 1099 miscellaneous should really only be used for things like rent reporting, royalty income, other income, sharing and fishing boat catches and hauls, which is always unique. Haven't really seen those here in Lancaster County. Not really one that we see often on the Susquehanna River, that people are going out and sharing their proceeds from catfish or bass. But we can see the 1099 NEC. It is a form coming from an outside payer. So generally, you're going to be doing work as a subcontractor or as a non-employee. There's also another one popular showing up here as a 1099K. So the 1099K is actually a form that's going to be showing credit card payments, credit card transactions. So this is going to apply for people who might be taking card processing, whether it be a hairdresser, whether someone's now taking credit card payments through apps like Venmo or Cash App. If they're getting paid for things for selling product on Etsy, if they're selling tickets on retail sites like StubHub or SeatGeek, they might be getting 1099Ks. So the original premise last year is they wanted to drop that threshold way down because they thought there was a pretty strong hidden economy out there. Bit of a battle. That threshold never went into place for 2022. 2023, that might be back to $600. So we may see more transactions coming through on a 1099K. Again, 1099K, a lot more information in your 4012 on the D24 and D25 of reporting income. So from an income standpoint, just want to reiterate, income can be coming in through a variety of sources. It could be a 1099 NEC, effectively where a business is paying an individual. It could be a 1099K where the individual is taking credit card receipts. They could be self-reporting their income. We just want to be sure if they give us the information that we identify where that's coming from. So if an individual who's self-employed says, I'm bringing you a sheet that says, here's my income, $9,800, and I have all my expenses listed. I also have a 1099K for $4,000. We just want to be sure, did your information of $9,800 already include the $4,000 of 1099K? We don't want to enter that more than once. Likewise, we don't want to leave that off if that's actually part of the income. So might be some clarification questions with the individual for business activity. So just want to see, again, 1099 NEC, 1099K, or self-reported of cash income are the general ways we'll see business income coming through. For business expenses, just want to mention a couple of things that are within scope for VITA. Advertising. So if someone is actually going ahead and buying a website, they're going ahead and printing up business cards, they have t-shirts printed, they're going to rent space on a billboard, all of that is acceptable advertising. What's not acceptable advertising is putting a little sticker on your car and driving all around town at fast speeds, telling people, please use my services for fast and quick delivery of your products. They can't see the sign. It is not allowable as a mileage expense to drive around thinking you're a mobile advertising. But we can take car and truck expenses used in business, going to be based on standard mileage rates. So what we're looking at is if you have a fixed location you go to, the drive from home to your work location is a commuting cost. That's not deductible. But once you're at your work location, if you go to multiple different areas, that's all deductible business travel. Even though we can't do a home office deduction, if you're working out of your home, if you're driving to go clean houses at client locations, that's deductible business mileage. You need to keep accurate records. What the IRS requests is what they call contemporaneous records. So that means that the taxpayer is responsible for coming up with a mileage log of how many miles have they driven for business, the date, the mileage, the purpose of the trip. We can use the information the client provides to us. A big caution, we have to remind the client that they are responsible if the IRS wants documentation. It is going to be the taxpayer responsible to support the figures that they're telling us to put on the return. So we have to emphasize that point. In the case of the IRS audit, these are the taxpayers' numbers, not ours. So we can take things like the car and truck expenses, commissions and fees, insurance, if they have interest, and I'll talk about a couple of these more specifically related to driving services. Legal and professional services, again, hopefully they're not going to an attorney or an outside accountant and then coming back and having us do their return for free. But if they do have professional services, they could be coaching or counseling services. Office expenses can be things like office supplies, pens, papers, that type of thing. If they rent or lease equipment or machinery. So for example, if you have an individual who's painting on the side, and they may have to rent scaffolding for a project, that's going to be deductible. Any repairs and maintenance to their equipment, we cannot depreciate it, but we can go ahead and deduct the costs of repairs and maintenance. Things like supplies are fine. Any type of travel that they may have for business purposes. If they have a business meal. So a business meal does not mean I had dinner with my neighbor and said, if you're ever interested, give me a call. It has to be a business-oriented meeting, and there are some limitations we have for business meals. We have had up to 100% deductibility if the meal was prepared by a restaurant. If it was not prepared by a restaurant, typically it's only a 50% deduction. Again, must be substantiated by the taxpayer and has to have a business connection with it. A couple other things I just want to mention as we move into more popular Uber or other car services. We do have Uber, we have Lyft. We may have clients that have Amish taxi service, effectively the same type of thing, only the Amish are not very good at apps, so they're not going to use the same type of contractual relationship. Again, if you have more than $400 of self-employment income, you need to report that information on a 1040, even if you're under the other filing thresholds. So generally an Uber driver, Lyft driver, someone driving for Instacart or any of the other delivery services like DoorDash will be getting a 1099 NEC or a 1099K. We do need to, again, report that on Schedule C. Getting back to the driving services, typically the apps will provide a lot of great information. We typically want the client to download that information or provide a copy so that we can see the amount of deductible miles they have while driving. They usually get that off their phone. That'll talk about all their expenses. That'll include not only the amount of income they receive, but also do they pay any fees, like credit card or commission fees to Uber or Lyft. Again, the car and truck expenses are typically there based on standard mileage. They do not need to bring in their oil change receipts or gas. We can only do standard mileage. They may have additional insurance that they have to provide. So auto insurance on their car is not deductible because they need that to drive the car. But if they bought additional, maybe supplemental coverage, that would be deductible. If they have office expenses, again, we're not anticipating a lot of office expenses for someone driving. Virtually everything is done through an app, so we're not really expecting them to hand out a lot of stationery and paperwork. But what is deductible that they may not have running through the app are things like supplies, cleaning supplies that they use for their vehicle, car washes for the vehicle. Could be that they're providing water or snacks or something for their passengers. That is deductible. Also, the use of a cell phone, because now all of their apps are running off that cell phone, including all of their information for revenue, expenses, navigation. we can actually take a cell phone used in business. So does that mean if we have one driver and they have a family plan where there's 5 phones, we take the entire plan? Absolutely not. The best bet we'd have in that case is probably to allocate to say, if one phone's used for business and there are 5 people on the plan, we'll take 1/5 or 20% of the bill. So we do want to document the business purpose for those activities. So that is generally what we're going to see for Uber drivers or people who might have delivery service. They should have a lot of that information. And hopefully they know that they are not an employee of Uber. They are actually self-employed and are responsible for paying their own federal, state, and local income tax, in addition to their share of Medicare and Social Security. All right, so we saw a question in the chat involving gambling winnings and other income, and now's a great time to bring that up. We're getting a little deep in the D section here of the 4012. We're down in D65. So gambling winnings are actually going to be reported on a Form W-2G. And the downside is for the gambling reporting is typically a W-2G is going to be issued every time our taxpayer has hit a gambling winning over $600. So we have a prevalence of casinos in this area. We also have the ability, if you're in the Commonwealth of Pennsylvania of legal gambling age, you can play casino games online. Every time that you hit a jackpot, you will be issued a W-2G. Those do have to be entered into our TaxSlayer program. So it could take a little bit of time to get some of those in if we have a couple winnings. So any winnings that you have from any type of gambling activity needs to be reported, particularly if it's on a W-2G. If you have gambling winnings not on a W-2G, you should, by tax law, report those winnings as well. You can add those in, whether it's from playing a fantasy football league, whether it's you bet your best friend whether or not you can actually still do a push-up at your age. That can work too. That is technically earnings that you have that you should be reporting. But when we talk about gambling winnings specifically, gambling winnings in the W-2G, we'll put that into the federal section income less common income. You are allowed to take gambling losses to the extent of gambling income with an important caveat. Those are going to be considered itemized deductions. So the problem is if the taxpayer does not itemize, they get no benefit for their gambling losses. And those gambling losses can only go up to the extent of gambling winnings. I have had client situations with Invita, a situation that they had won $90,000 over the years at the casino games by playing on their phone app. They had gotten addicted to the program, so anytime they were sitting still, they would go on their phone and spin their wheel, and every once in a while, they'd hit a jackpot. So every time they got over $600, they'd get a W-2G. At the end of the year, it ended up over $90,000. Now, maybe fortunately or unfortunately for them, they lost all of the money. They kept betting the money instead of cashing it out. So because we could document the fact that they had gambling losses, and you can do that either with the app to show what your deposits are, or to show the losses, or if you are going ahead and keeping a copy of all your lottery tickets that didn't win, or your horse betting slips, those are all documentation of gambling losses. You can take those against gambling winnings, and you can certainly do that for PA. No problem there with itemized deductions. But for federal, if you don't itemize, you do not get those benefits. So in her case, she had substantial winnings, and her losses were so substantial that they actually created an itemized deduction for her. So she got to a point where she did not have any tax due on the gambling winnings. Now, her fiance, on the other hand, had also been playing, but had not lost nearly as much. So he won $10,000 or so, I think maybe 10 or 12,000. But because he did not have enough gambling losses to make him an itemized deduction individual, he didn't get any benefit for those losses. So he had to pay tax on the full amount of the gambling winnings, even though at the end of the day, he was in a net neutral position. So gambling winnings, we do have to report if you can itemize or if you have a lot of gambling losses. Again, not that we want to encourage tax planning. So if a client comes in and like, well, I won some, but I lost some. You don't want to say, hey, next time gamble even more, try and lose a whole lot so we can take an itemized deduction. No, we don't want to encourage that. But if they do get to the point where we get an itemized deduction, that's even better. It's going to offset those substantial winnings. We mentioned a couple other items, jury duty pay. So if you are getting paid for jury duty, much like anything else, if they bring in their jury duty pay slip and they're like, I was paid $13 for showing up for jury duty, got to sit around all morning, catch up on the newspaper, read a couple books, and then got dismissed, that's fine. We can report the jury duty pay. It's technically taxable income. If they turn their jury duty pay back to their employer and their employer just paid them regular wages for the day, we do not have to report the jury duty pay. But technically, jury duty pay, other income listed elsewhere, so that might be prizes and awards you may see on a 1099 miscellaneous. So if someone wins a radio contest or some other type of prize or award, typically that'll be reported in box 3. Okay, and the last thing I wanted to mention this evening is just taking a look here at our very last category, and that's debt cancellation. It is very, very deep in the D section, D69, which sounds like we're already playing bingo here. But debt cancellation is the opportunity for an individual to have personal debts forgiven. So the most common scenario where we see this within VITA is someone may have credit card debt or store debt, and they cannot pay those. So they go ahead and they work with a credit consolidation or debt forgiveness program, and they will have their balance reduced. So the credit card company will say, even if you owe us $5,000, that's fine. I'll forgive half of that. So $2,500 will go away. You still owe us $2,500. Well, the $2,500 that the credit card company is forgiven is not cash, but it's still income because the individual had gotten some benefit, whether it's paying for clothing or food or travel. They've gotten some sort of tangible benefit without having cash. So that's still considered income for federal tax purposes. So if the individual has had more than $600 of debt forgiven, they will be getting a Form 1099-C. And we can actually prepare that. We can enter that information in on TaxSlayer as other income. And as long as that is personal debt, meaning it's not business debt, so it's not related to a business activity, it's reported on the 1099-C because it's over $600. Again, no business connection at all with that activity, not bankruptcy related, and not claiming insolvency exemption. So insolvency exemption, we have that on D70. That allows the taxpayer to get out of taxability, provided that they have more debt than what they have in assets, that they have more that they owe than what they have in tangible assets that they can use to pay those liabilities. Insolvency exemption is outside the scope of VITA, but we do have a relationship with Mid-Penn Legal Services, which I believe will be coming in probably at our last session. Kim and I will work on that and talk about what services they can offer for our clients. But they can typically help them through insolvency or other issues related with taxes. Certain student loan forgiveness is still in scope for 2023, but any debt cancellation that is related to credit cards is going to show up as other income. And we would just follow the TaxSlayer rules, follow D69 for your guidance on how to handle debt cancellation. All right, so that has gotten us through, what do we have? 31 slides in a relatively quick period of time. So want to keep this open now for questions and see how we're feeling with any open items that we'd like to address this evening while we're all together.
There
Yep,
is
I'm sorry,
one
Kim.
question in the chat, Jared.
Okay, perfect. Okay. All right. Digital assets, cryptocurrency within scope. All right. So one of the things you may have noticed if you have been a tax preparer for a little while here in VITA is there is a question on the income tax return. Do you have any financial interest in cryptocurrency? The exact verbiage has changed a bit over time, but effectively asking, how are we looking in terms of cryptocurrency? So cryptocurrency technically can still be within VITA if you're buying and selling as investment property. So if you're using something like CoinTracker or Coinbase to go ahead and use cryptocurrency, if you are a big fan of Matt Damon and he's telling you to go buy cryptocurrency as an investment, that's entirely fine. It's going to be treated much like stocks and bonds. So we can still report that. That's going to be basically going through a Schedule D, the 8949. I believe that's still within scope of VITA because it is basically just an investment activity. If you are using cryptocurrency as a way to get around the government tracking your money. If you know what the dark web is and you're doing things that you shouldn't be doing, technically you're still supposed to report that as income. For those of you who are not aware, Al Capone, famous gangster, had done a lot of criminal things, but the reason why he went to jail, tax evasion. The reason why he was convicted of tax evasion, he never reported his his income from gambling, bootlegging, extortion, all the other felonies that he was involved in. Got to jail because he failed to pay income tax on those illegal activities. But if you're just using crypto as an investment activity, we're still going to be able to report that. That's still going to be an investment activity on the 8949 Schedule D if you're buying and selling. If you're using crypto as a main way as your kind of activity to go ahead and buy and pay for things, that's outside our scope. So I don't think we're using those when we get in that classification. Do you have more you need to report? That I believe is pretty much outside the VITA scope on where we want to be in terms of financial reporting. But again, if it's just an investment activity, we should be okay. All right. Great. So it looks like we're caught up on the chat so far, Kim.
Nope.
Okay. Wonderful. So now's the time where we are open forum. So any questions you have, any question a friend of yours may have that you'd like to ask right now, any situations you may have run into or hoping to run into or not run into a tax season are certainly fair game. Talking about income. As a reminder, our upcoming sessions next week, we're going to be talking about deductions and credits, and we're going to follow with Section 4, which will be state and local taxation, military, and if we're okay to do it, Kim, I think that'll be the time we bring MidPen in for their
Yeah,
presentation.
I'm going to get in touch with him.
Okay,
Yep.
perfect. Wonderful.
Jared, does the debt cancellation also work the same for someone who had owed money to the IRS in previous years and worked out a debt agreement with them and has wages that are garnished? Because I remember a case like that came up and we didn't go through it because he didn't have all the information that we needed. But I'm just curious, does that follow the same course of action as like a debt cancellation from a credit card issue or whatever?
So those are usually different. So kind of resolving in debt with the IRS is not in the same classification. So a credit card debt, usually what we see here, Barry, is that you used your credit card, you bought something, and you're not going to pay for it. So you've gotten something of value. Sometimes with the IRS, it can be a question of legal matter that maybe you resolved an issue and you said, okay, well, I think that you want me to pay this. I think I want to pay that. And we may have a resolution somewhere in the middle. Or we may go through a IRS official tax forgiveness program. But basically, those are going to be outside the scope of VITA in this case. But technically, they're not going to be reported on 1099-C either. So the IRS doesn't treat you as, you don't get a deduction for your income tax deduction anyway. So they're not going to have the position to say, we're going to try and tax you on that activity. So yes, so technically not within scope, but we're probably not going to see that showing up as a item of taxability for VITA to try and pick up. But again, special circumstances, Barry, we can take a look and see exactly what that situation is and determine the best course of action.
Another question on crypto investments.
Okay.
Were they in scope before this year?
Good question. I think that's kind of a policy question, Kim. I think technically they probably would have been if they're being reported on the traditional Form 8949 or the Schedule D. I'm not aware that we made a change here that these are going to be in or out of scope. I don't recall that from a IRS perspective that they were out of scope, but we may not have seen those much or maybe even encourage them to come in.
I know we did some last year.
Okay.
I remember doing some at VITA Central, but I also know there were ones that we did not because it was out of scope. So, but I couldn't tell you exactly what the situation was. I just remember Ed explaining it to a couple of different people.
Yeah. Okay. So I don't know that the rules have necessarily changed. If they're relatively basic and they provide all the information, crypto's relatively easy to work with. If they have done really well in crypto, their income is going to be well above $70,000 and they shouldn't be here in VITA. Unfortunately, not everyone's making multi-billionaires out of the crypto market like they originally thought and investment. So there may be some in there that may have bought or sold a little bit. But as long as they're officially reported, again, coming out of a coin tracker or coin wallet, we can go ahead and treat those much like capital gain activities.
Garrett, this is Annette. A
Yeah.
question on sale of stock, particularly the non-covered stock.
Mhm.
And I saw a few of these last year where retirees sold stock. And as you pointed out, they've had this stock for umpteen years. They've had this stock forever.
Mhm.
And this non-covered stock, there was no cost basis on the stock. So we explained to the individual, you're going to need to talk to your broker, figure out what this basis is,
Mhm.
so we can report this. And in two cases, it worked out fine where they were able to get the broker involved.
Mhm.
In another case, they could not get
Mhm.
the broker to give them the information.
Mhm.
And at this point, we said, well, if we report it as zero, you're going to have a pretty big tax bill. And unfortunately, we couldn't help her.
Mhm.
So in that particular case, is there any advice you could give when you see this non-covered stock and there's
Mhm.
no basis, and generally they're elderly people and they don't even know who to call and how to get this resolved. So is
Right.
any advice would be helpful.
Yeah, that's a great question, Annette. And we sometimes have that. I actually have that with some of my clients is they may have had stock for decades that they're selling, like the First National Bank of Shennick, that has now become at some point Wells Fargo or something like that. As you've gone through all these iterations, but they've held on to these securities forever. They may have inherited those at some point. They have no idea what the basis is. The downside is that we don't really have a great way to uncover that. So if they have an existing relationship, or if it is a bank stock, sometimes going back to the bank, they may be able to help produce something for them to say, if you inherited this in the 1960s, if we think your parents died in 1962, maybe we can come up with something we think is a relative basis information. But we cannot, unfortunately, come up with a basis category. Now, we can, as you mentioned, use zero. And in some cases for the individual, if it's all long-term capital gain that we know it should be, because it's non-covered, they might be at the 0% capital gain rate for federal purposes. So it may not be a federal downside, but obviously it's going to also impact PA and could potentially impact their PA tax forgiveness and PA rent rebate claim. So unfortunately, I don't know that there's a great area for us to turn them to other than an existing financial relationship or to a bank if they had bank stock. I don't know if Kim, if that's anything else United Way or Vita might have in resources or recommendations, but we, even in the tax profession, and we can do some research and come up with what we think is close, but certainly I don't think we have that. We're not going to do that within the Vita
No.
program.
Mhm. Yeah, thank you. Yeah, I just felt bad. We couldn't help her, and she was having a difficult time trying to get the information.
Yeah, that information is pretty much almost non-existent. And we hate to send them to a place somewhere in town where we know that they won't care. They'll put a number down on the return. One of the cash collection for tax payments, or do
Yeah.
advanced refunds, or have dancing characters or pyrotechnics in front of their location that are happy to do anything you want for the right price. So we hopefully do not send them to those locations. But unfortunately, we really cannot come up with a number for them within Vita. Maybe if we take a look, I don't know, Kim, if there's anyone involved in some of the finance committees or some of the banks that might be involved in the United Way, that maybe we could put out some feelers to see if they have anyone in their investment departments that might be able to provide some direction on how that could work. But fortunately, we have a couple months to look into that. And hopefully it's just a handful of individuals that run into that each year.
Thank you.
Sure. Okay, we still have 55 more minutes. We can sit around and talk about favorite tax stories, your income areas, any questions you may have with the presentation. Next week, we're going to do deductions and credits, which are going to be even more exciting because that actually helps take away our taxable income, helps build refunds for clients. We have extra time. We can share our favorite family recipes for the Thanksgiving, favorite places in the county to go get potatoes in bulk. I just realized I have a lot more relatives coming over than what I thought. So if anyone has any good leads on about 20 pounds of potatoes, let me know. I'm going to probably start peeling probably tomorrow to get ready for Thanksgiving, but we can certainly have more conversation through these activities.
Jared, I have
Jared,
another
I-
question, but not on potatoes. This
okay.
question has to do with the W-2 box 14.
Yes. Okay.
And I did see this a couple of years ago. It was a W-2 for a Lancaster School District employee. And it appeared as if they were putting the retirement contributions in box 14.
Correct.
And my question is, when we see that,
Mhm.
and I forget how we resolve this, do we move that over into the box 12 as retirement contributions, or leave it in box 14 and don't do anything?
Right. You're right. So what you're probably referring to, Annette, it would be like the Peasers contribution.
Yes, that's
So
it.
that's typically shown in box 14. So you leave it there. You don't move it over to box 12. So box 12 actually has some implications that would go throughout the return. So we'll talk a little bit more about the retirement savers credit, the 8880.
Okay.
And I know that's been an area, a little bit of controversy here with Invited, depending on what site we're at, whether or not we include Peasers in the 8880 or not. But you bring up a great point. Sometimes there are pieces in that box 14 that may be applicable on the return. Typically not. Typically, they're only going to be used for maybe itemized deductions, but anything in box 14 does not carry to the rest of the return. But kind of talk about educators. Sometimes the union dues may show up in box 14, although I think there's been a recent change in most payroll that they don't actually have a payroll deduction anymore, that they need to pay those out of pocket. But sometimes there's some information in box 14 that might be relevant for other pieces on the return. So things like union dues, we can take as a Pennsylvania unreimbursed employee expense. For example, the Peasers, I'll mention that next week. And we'll talk about the official position with VITA on what we do with the Peasers contribution and make sure that we're on the same page with that.
Thank you.
Yeah, absolutely.
Jared,
Yes.
I had a comment or question, I guess both. $10,000 limit on business expense seems like a very low ceiling for an Uber driver, because you figure they're about 40 to 60% of the income is dedicated towards processing fees and things that they charge from Uber and Lyft.
Right.
So that means that they're netting somewhere around 15 at max to still be in scope.
Right. So I think the 10,000, and we can take a look at that, Kim. I'm trying to determine if that was a VITA Lancaster requirement or if that's a IRS. And I believe what we're looking at, Ed, is that if they have substantiation on the mileage, if it's coming through their driving app, the IRS is much more likely to take that than if they're just writing down that they have kind of, if their Schedule C business is babysitting and they have $9,000 of income, but they bought $8,000 worth of toys and snacks for the year. So there's some caution there on how much we take a look at what the IRS is willing to allow to come through the VITA program. Just because the Schedule C does have some opportunity, not that we really see it within the VITA program, but does have a little bit more opportunity for someone to go ahead and have try to manipulate a free tax program to generate additional earned income credit. So they're not intending to have kind of an active business come through, really more of a side business. And I think policy-wise, Kim, I'll kind of unfortunately kick it back to you to see. We've been kind of using that 10,000 as a while. I know the Schedule C goes up to 25,000. So I'm not quite sure where we're kind of falling on that for processing returns.
Not, I am not sure what to tell you. I mean, if that's what was in place before, I, because of just this being my second year now.
Yeah.
We'll keep it at what it's always been for now. Yeah.
Okay. We'll run that by our other Ed to determine what
Yeah.
he wants to.
Okay.
Yeah. Okay.
Okay.
Yeah. But yeah, so certainly I agree, Ed. I mean, there may be some opportunities, particularly if someone is very much engaged in driving for Uber. I have a couple people I know that's almost their primary source of income, that they'll
Right.
spend time on the weekends driving, and obviously that their predominant expense for Uber will be their mileage. So the IRS is mainly concerned about someone who's coming in and we're trying to account for all kinds of different activities like property taxes and supplies and materials and things like that. They really don't want depreciation. They don't want employees. They don't want inventory. So in most of these is probably where we're seeing in the majority of cases is people with very little expenses. So if I'm going to go help paint on the weekends, my expenses may be a handful of brushes and some drop cloths. So they're not anticipating that I'm going to have 10 grand. But you are correct, from an Uber perspective, I might have a lot of mileage. If I'm driving between airports and hotels and saying I want to do that long distance hauling in for the big money, or just spending all my weekend in moving people around, then I might have a couple more expenses. So I think in general, what we're looking for is kind of that big ticket item, the 10,000. But again, we'll kind of play that by ear. We don't want someone came within like 200,000 of gross income and $150,000.
No.
So that'll
What
definitely
I
be
was
out of
saying
the
is,
Yeah.
what I had seen, at least the last 2 years, is if you have an Uber driver or Lyft driver that and again their 1099 is a net value of, let's say, 50 or 60,000. The network and the booking and all the fees that Uber charges up front
Mhm.
will take about somewhere between 40% of their net right off the bat. So if they got 60 grand, you can expect, somewhere around 30 grand of that is going to be cut right off the top before they even go to your mileage expense.
Okay.
And that's just by my experience with the Uber and the Lyft.
Sure.
And those fees can well exceed that 10,000, obviously.
Sure.
And that's just straight off the form.
Yeah, and they're so their 1099 NEC that they're reporting at is going to be that 60, and then they're going to show all the fees that they're withholding or coming off of 1099K. Has that been your experience?
Yes, yeah.
Okay.
You'll usually get a statement from Uber or Lyft, and it says, here's what your net was.
Right.
Here's what your gross was. Here's all, I'm sorry, I used the word net and said gross, but here's your gross, and I'm waving frantically like you can see me because my camera stopped working. But
Okay.
and they'll show you all of the fees that they charged, and then a bottom number is this is what you actually got paid out. But since you're 1099, your gross amount is what's reported on the 1099.
Right. So they're going to use that 60,000 on the 1099 as it's being issued. Yeah. Yeah. So I think that's an interesting case. I don't know that we've seen that up here too much in our area with the $60,000 figures. But I believe and that might be, I think that the Schedule C, if I take a look back at that, I believe from a VITA perspective, that might have been at a $25,000 threshold. And we may have in Lancaster County capped that at 10, just for our own purposes. And again, I'm trying to dig through some information as I'm talking here. But yeah, so that I think that might be a little bit of interpretation depending on where you're preparing the returns. So the Schedule C does allow up to $25,000 of expenses within tax layer, but I believe that what we have done within our VITA program here in Lancaster County is capped at 10, or traditionally capped at 10. I don't know if that helps in kind of that discussion.
Thank you.
Yeah, thank you, Ed.
Oh, one other question. If you have multiple 1099s, but they're both for like Uber and Lyft, you don't create separate Schedule Cs in your area. They're all reported on a single
Correct. Right. If they're all related to the same business, I would put them all on the same Schedule C. So you can combine multiple 1099s all in the same Schedule C. And we run into that. I've worked with people who do cleaning service. So they may go ahead and they work with businesses and usually you're looking at people who are going to be issuing 1099. So it would be like your Uber, Lyft companies. It would be if you're cleaning for a bank or some other company, they're going to issue a 1099 NEC. We'll combine all those on one Schedule C. So you might have a Schedule C business as a cleaning service, and maybe if they do Lyft or DoorDash on the side, you might have transportation services or some other title you're going to use for the Schedule C. But I would absolutely combine all the 1099s that are related to that business into one Schedule C, as opposed to have multiple Schedule Cs.
That's what we do as well.
Yep, perfect. Yep, I'm right on board with that, Ed. Great strategy.
Okay, one last question, I promise. For income, do you do rental properties at all?
We do not do those through our official VITA program. However, within our allotment, we are allowed to do friends and family returns. So I don't know if anyone has done them for friends and family, Kim, but officially we don't do them for our site. And again, the reason that is mainly because of the depreciation component. Even though TaxSlayer does allow for depreciation, we have taken the position that our volunteers, we will not be able to train them effectively for depreciation issues when it comes to identifying asset cost and just taking a look at depreciation carryover. And then obviously when you have sales, what are the issues involved with selling a rental property? Probably technically you could do a Schedule E if you had land rental and you don't have any depreciation, but we don't really do that here either. Even though probably we probably have a little bit more farmland rental than most other areas in the country. People who might have a couple acres that they lease out to a farmer, but we don't typically handle the Schedule E activities either. I think we'll handle a couple K1s on a case-by-case basis, Kim, if they're very, very basic, but generally not as a matter of course. Do we handle those as well? So typically we avoid the E's and the F's up here.
All right. I think we got all the questions in the chat.
Okay, perfect. Good. And again, happy to entertain any questions people have. Want to be sure that we're well prepared for this tax season. Good news is not a whole lot of changes from the prior tax season yet, and we're hoping that stays that way. But we can definitely see what's going to be happening down the road here. So we have a couple more weeks to see what's going to be occurring. Again, I'll be with you through the end of November here for our training. I'll be keeping an eye on things as we take a look at developments within tax law between now and the start of the season. And if we need to, we'll do another session on additional changes. And I think we've even kicked around if we are expanding our scope to handle a couple more certifications. We may end up doing some training as well for foreign activities. So we'll be taking a look at whether or not we want to go ahead and do additional training on how to handle resident aliens and preparing returns along those lines. So we've gotten a lot of requests from community to provide additional services. So if you're ready to soldier on, we're ready to take you on and help train you and move you to the next level here. So definitely as much as you'd like to take on, we're ready to help get you there.
Yep.
And is that the new motto of VITA, Kim? Yeah.
I'm sorry?
The new motto of VITA is
yes.
Whatever you want to take on, we'll help get you there.
That's right.
We'll definitely make sure that we prepare our services for anyone who needs them within our community. So we're always looking at ways in which we can do that more effectively.
All righty.
Okay. Well, absent any other questions, we'll let everyone kind of drop off here, and we'll see you back hopefully next Thursday for the exciting portion of deductions and credits. It gets better and better as we move on. And then fourth session, we'll do state, local, military, and we'll get Mid-Penn Legal Services in here to talk about some of the services they offer for our clients as well. So hope everyone has a great evening. We'll catch up with you next week. And thank you so much for your time and attention tonight. I'll talk to you later.